In today's video, we are going to look at the last 4 types of candlestick. We are remaining with only 4. We have the hammer, we have the shooting bar candlestick, we have the harami, or what we call the inside bar, then we have tweezer bottoms and tops. But for your own good, it is better you turn on that red button to black by subscribing. You can also turn on the notification bell for you to be in a position to get notified in case a new video is dropped here. So we have the hammer, or what you may call the penny bar candlestick pattern, and is created when the open high and the close are roughly at the same price. It is also characterized by a long lower shadow that indicates a bullish rejection from buyers and their intention to push the market higher. It is characterized by a longer lower shadow indicating the buyer's intention to push the market higher. You can see this in the illustration below and observe how it looks like. That is what we call the hammer or the penny candlestick pattern. It consists of a longer shadow, the opening price, and the closing price. This hammer that we are seeing is a reversal candle pattern when it occurs at the bottom of a downtrend. This candle forms when sellers push the market lower after the open. It forms when the sellers are pushing the market after the opening price, but they are rejected by buyers, so the market closes higher than the lowest price. You can see this in the example below. We have the small body and the long lower shadow. At first, the sellers were overtaking the market, and after the formation of a hammer with a long lower shadow, then the buyers gained the control of the market. As you can see, the market was trending down. The formation of the hammer opening bar was a significant reversal pattern. I repeat, the formation of a hammer or a penny bar was a significant reversal pattern. The long shadow represents the high buying pressure from this point. Sellers were trying to push the market lower, but in that level, the buying power was more powerful than the selling pressure. which resulted into a trend reversal. But the most important to understand is the physiology behind the formation of this candlestick. If you can understand how and why it is created, you will be able to predict the market direction with high accuracy. We will talk about how to trade this pattern and see and how to filter the signal from this candlestick in the next chapters. Let us look at the second candlestick pattern for today, and it is called the shooting bar, or what we call the bearish penny bar. The shooting formation is formed when the opening low and the close are roughly the same price. This candle is characterized by a small body and a long upper shadow. It is a bearish version of the hammer. In other words, it is a bearish version of the hammer candlestick. Professional technicians say that the shadow should be twice the length of the real body. You can see in the example, this is the shooting bar. It has the long upper shadow. We have the opening price and the closing price. By observing this illustration, you can see that it shows us a perfect shooting bar. With a real small body and the upper long shadow. When this pattern occurs in an uptrend, it indicates a bearish reversal signal. The physiology behind the formation of this pattern is that buyers try to push the market higher, but they get rejected by the selling pressure. I repeat, the physiology behind the shooting bar candlestick pattern is that the buyers try to push the market higher, but they are rejected by the selling pressure. And when this candlestick forms near the resistance level, it should be taken as a high profitability setup. You can see the illustration below. We have the shooting bar there. So here the candlestick is called a bearish pin or shooting bar. The chart above, you can first observe the chart. It shows us a nice shooting star at the end of an uptrend. This is the uptrend, and we have the formation of a shooting bar with a long lower shadow. It is formed when buyers try to push the market but they are rejected by the high selling pressure from the sellers. And the formation of this candlestick indicates the end of the uptrend move and the beginning of a new downward trend. As you can observe, After formation of the shooting bar, we are getting another trend down. It works as the end of the ongoing uptrend and the beginning of a new downtrend. The new downtrend is characterized by a high selling pressure. This candlestick can also be used with support and resistance supply plus the demand areas and with technical indicators. The shooting star is very easy to identify and it is very profitable. It is one of the most powerful signals that you can use to enter the market. In the next chapters, I will talk about it in the details and I will show you step by step how to make money trading this price action pattern. Let us look at the third candlestick pattern in this video, and it is called the Harami candlestick pattern. It is considered as a reversal and a continuation pattern. With this, it consists of two candlesticks. The first candlestick is a large candle and it is called the mother candle, followed by the smaller candle which is characterized or which is called the baby. I repeat, the first candle is the large candle and it is called the mother candle. It is followed by the formation of a smaller candle which is called the baby, what we call the baby candle. For the Harami pattern to be valid, the second candle should close outside the previous one. I repeat, for the Harami candlestick pattern to be valid, the second candle should close outside the previous one. And this candlestick pattern is considered as a bearish reversal signal when it occurs at the top of an uptrend, and it is a bullish signal when it occurs at the bottom of the downtrend. You can see in the illustration below. We have the mother candle and the smaller candle, which we call the baby candle. This is how the Harami pattern looks like. You can observe it very well. We have two of them. In the first illustration, we are seeing that the smaller body is showing up in the downtrend. And in the second illustration, we are seeing that the smaller body, what we call the baby, is showing up in the uptrend. In the first illustration, the baby candle is in the downtrend, and in the second illustration, the baby candle is showing up in the uptrend. As you can see, the smaller body is totally covered by the previous mother candle. Don't bother yourself with the colors. The most important thing is that the smaller body closes inside of the first bigger candle. The Harami candlestick pattern also tells us that the market is in indecision period. In other words, the market is consolidating, so the buyers don't know what to do at this level. The buyers and sellers don't know what to do at this level, and there is no one in control of the market. When this candlestick pattern happens during an uptrend or a downstream, it is interpreted as a continuation pattern, which gives a good opportunity to join the trend. And if it occurred at the bottom of an uptrend or at the top of an if it occurred at the top of an uptrend or at the bottom of a downtrend, it is considered as a trend reversal signal. Look at this example here. I want you to observe it very well. Here we have a baby, or we call the baby candle, and we have the baby candle is forming or covered by the mother body or the mother candle in the downtrend here. But here, the baby candle is formed in the uptrend and covered by the mother candle. Down the trend, we call it a bullish Harami candlestick pattern, and in the uptrend we call it a bearish Harami candlestick pattern. It can form either in the uptrend or the downtrend, as you have observed. It forms in two ways. In the chart above, you can see how the trend direction changes after the Harami pattern formation. The first bullish Harami pattern occurred at the bottom of a downtrend, meaning that the sellers were pushing the market lower. But suddenly, prices start consolidating, and this indicates that the selling power is no longer in control of the market. The bearish Harami candlestick pattern is opposite of the bullish. This is the bearish Harami candlestick pattern. Is opposite of the bullish one. This one occurred at the top of an uptrend, indicating that the buyer's domination is over and the beginning of a downtrend is possible. When this pattern is created during an uptrend or a downtrend, it indicates a continuation signal with the direction of the market. We will study in details how to trade this pattern either as a reversal pattern or as a continuation pattern in the next chapters. Let us look at the last candlestick pattern for today, and it is called tweezer tops and bottoms. Tweezer top formation is considered as a bearish reversal pattern seen at the top of an uptrend. The tweezer bottoms formation is interpreted as a bullish reversal pattern seen at the bottom of a downtrend. You can see we have the bearish candle and the bullish candle. Tweezer top formation is considered as a bearish one, and it is seen at the top of an uptrend, while the tweezer bottoms formation is interpreted as a bullish reversal pattern seen at the bottom of a downtrend. This is what we call the tweezer bottom, the first one, and the second one is what we call a tweezer top. You can observe this. In the illustration here, we have the tweezer top, and in the first illustration, we have the tweezer bottom. The tweezer top formation consists of two candlesticks. I mean this, the tweezer top. It consists of two candlesticks. The first one is a bullish candle followed by a bearish candlestick. The first one is a bullish candle followed by a bearish candlestick. And the tweezer bottom formation consists of two candlesticks as well. The first one is a bearish candle followed by a bullish candlestick. As you may see, the first one is a bearish and the second one is the bullish. So we can say that the tweezer bottom is a bullish version of the tweezer tops. I repeat, we can say that tweezer bottom is a bullish version of the tweezer tops. The tweezer bottom is a bullish version of the tweezer tops. The tweezer top occurs during an uptrend when the buyers are pushing the prices higher. This gives us an impression that the market is still going up, but sellers surprises the buyers by pushing the market prices lower and close down the open of the bullish candle. This price action pattern indicates a bullish trend reversal, and we can trade it if we can combine this signal with other technical tools. The tweezer bottom candlesticks happens during a downtrend when the sellers are pushing the market lower. We feel that everything is going all right, but in the next session, price closes above or roughly at the same price of the first bearish candle, which indicates that the buyers are coming to reverse the market direction. If this price action happens near a support level, it indicates that a bearish reversal is likely to happen. You can observe this. Here we have the tweezer bottoms, and in the chart above, we can see the tweezer bottoms that occur in the down trend. The bears push the market downward on the first session. The bears, I mean the sellers. The bears pushed the market downwards on the first session, as you may see here in the first session. However, the second session opened where prices closed on the first session and went straight up, indicating a reversal buy signal that you can trade if you have other elements that can confirm your buying decision. But do not focus on the name of a candlestick, but just try to understand the physiology behind its formation, because it is the most important. Because you can understand why it was formed, you understand what happened in the market, and you can easily predict the future price movement. I think that is enough for today, guys. In the next video, we shall be looking at the candlestick pattern exercise, how the candlesticks behave in the market. We shall be looking at the candlestick pattern exercise, how you can identify that this candlestick is a gravestone with the type of candlestick that is formed in the market, how you can identify it. So that's what we shall be looking at in the next video. Thank you for watching.